Well, we have it in the UK. 300,000 people a month are coming off fixed rate mortgages into variable rates, and the interest rates on the fixed rates have gone up, but there actually isn't a huge supply because a lot of the products have been withdrawn from the market. Was it 40%, Danny, of mortgage products, I think, were removed from the market?
Was that just on the back of the stuff that was happening, or is that for long term?
No, that was on the back, but we haven't seen it. I'm pretty sure there's a meeting that's meant to be happening with Kwasi. What's his name? Kwasi Kwarteng. Yeah, him and some of the CEOs of the banks in the UK to try and get, because they've reduced the stamp duty rate, which is kind of always used to stimulate the housing market. They usually do it at the bottom end because it's just adds a big expense to it. Interesting.
Yeah, so the reason that this crazy rise in treasury yields is so talked about and so important. A lot of people are just discovering these markets, and they're saying, well, why on earth is Bitcoin Twitter now completely shifted gears to talking about this huge sell-off in the United States government securities and government securities in general? You take a look at other sovereign bonds. Why is this so important? Well, the United States Treasury market, that same dynamic we talked about with people borrowing at a spread to mortgages for their mortgages, that's also the same for everything else. So the credit card you're getting, the variable rate credit card you're getting, that's at a spread to a premium to the corresponding tenor on the treasury yield curve, right? Or any other number of reference rates that are referenced to dictate the borrowing costs for any other instrument for people, for corporations, for sovereigns. So the reason this rise is so worrisome is because obviously it's fast, obviously it's aggressive, but everybody borrows at a spread to these rates, right? For everything, right? So every form of credit that's extended is at a premium based on creditworthiness. It could be wider, it could be tighter to these rates. And right now you're starting to see the impact of that with emerging funding stress. You're starting to see investment grade credit default swaps. You talked about credit default swaps. So credit default swaps for investment grade companies, right? We're talking, our Apple or Google or Microsoft, not necessarily those big players, but people who are akin to them, right? Maybe the next rung down in terms of creditworthiness. They're experiencing pretty extreme funding stress, and the market is pricing in a much higher likelihood of default for them.
Hold on, there's credit default swaps for Apple.
Yeah, there are. There are credit default swap instruments for basically anybody that issues corporate paper or paper for that matter.
I don't know if
bond default insurance. So
yeah, of course, but
a
like
bond that has a big enough market, investment banks are going to say, "Hey, I have an insurance product for you."
yeah, no, I get it. No, I get it. But just like who would be buying that? That's like going to the. That's like betting on Man U to win the league.
Yeah,
I mean, it's like there's a market for it. Who the fuck's going to buy it?
But there's a product to sell, right? And so yeah exactly. What the market is, what's the market for CDS on Apple? Probably not very wide. But there are also ETFs. They're called CDX, not CDS. So credit default swap ETFs and credit default swap indexes. So.
Right. Okay. So there's safer ones.
Yeah. So there are actual products that people can buy, not just other companies, but at the retail level as well. And for credit default swap indexes, that gives you a better idea of separating it into investment grade versus high yield. High yield in the blue, for those people who are listening on audio, it's skyrocketed basically in line with investment grade. So both more creditworthy borrowers and less creditworthy borrowers are now experiencing about 2 times the level of implied default risk than this time last year. And this is a result of rates across the board absolutely skyrocketing, right? And so the market is saying that the odds companies are going to default on this are increasing. It doesn't mean they're going to default, doesn't mean there's anything imminent. What it does show is that there's real funding stress for corporations starting to emerge.
So it's a signal for something else.
Yeah. That's the big issue for Credit Suisse. And that's the big issue for basically everyone, like you see here. So, it doesn't say that there's a huge bust imminent. What it does say is that the likelihood of a bust is increasing as these rates increase, and then this market implied default risk increases.
And so why is there stress on funding? Is there less money available, or is it because the rate at which you have to borrow at's gone up?
The rate at which you have to borrow it has gone up, right?
Yeah. So what's quite interesting, Danny, can you get up Ledden's website? Because one of the things I always found quite interesting was with the markets for borrowing and saving with Bitcoin products, the Leddens, the BlockFis, the Celsius, RAP. But the rates on them were always kind of high. Like if you wanted to borrow against your Bitcoin, let's see what their rates are. Let's have a look at Leddens.
There's a reason for that.
Yeah, and now I get it because it's a proper market.
That's exactly
it's not
right.
a suppressed market.
So
here we go. Let's just have a look at their rates. So annual interest rate of a Bitcoin-backed loan is 7.9%. So you look at something like that and go, I don't fucking pay that. I'm used to going to the bank and paying close to nothing.
That's exactly right. If we hadn't been in an interest rate environment where actual interest rates like these were held at the zero level, we'd be used to this. We'd be totally used to this.
Yeah, but we've been conditioned not to be used to this.
That's right.
Because it's not been like a fair, it's not been a fair free market for pricing this. It's been a suppressed market. But now I get it because this is pricing in real risk. What about their interest rate then? P2X, yeah.
So one thing before we go off this page actually is on Bitcoin-backed loans, if you scroll back down, you look at the loan-to-value ratio. This is extremely important. So we talk about fractional reserve banking, and the idea was brought up earlier when you were speaking with Nick about, well, how could a credit system exist on top of Bitcoin? And Dylan LeClaire has spoken about this as well.
Well, it's the opposite, isn't it?
Yeah, it'd be over collateralization of whatever loan you're getting. So let's say I want a $50 loan from you, very small. Well, then the value of my collateral would have to be $100.
I'll take your sneakers.
Oh, thank you. That's essentially what this loan to value ratio means. So in a market where there's actual risk associated, money cannot be lent into existence, and a loan has to generate positive real return, so you could pay the person who gave you the loan back. You see 50% loan to value rate, lower than 100% loan to value ratio, because the value of your collateral has to be more than the loan that you're getting, right? So if the value of your collateral drops, right, with something volatile like Bitcoin, you have the ability to pay it back before the lender gets underwater. That's what real interest rates look like.
Okay, so on BTC savings account, you can get up to 6% APY with no minimum balance paid in Bitcoin. I mean, so the spread there is the 6% to the 7.79?
7.9.
Yeah, I mean, that's where they're making them. Like, it all makes sense. Like, you look at this, you're like, okay, I get this now. That like, there is a cost to capital.
That's exactly right.
And there's a return on capital.
Yep.
Almost like that's how things should work.
Yeah.
It's funny how this Bitcoin thing makes sense, doesn't it?
It's remarkable.
Huh.
And to tie it back to what we were speaking about with sort of this suite of Lightning Network reference rates, there are a number of ways that market participants can earn a native yield on Bitcoin. Obviously, with cold storage Bitcoin, there's no native yield whatsoever, right? It sits, it doesn't do anything. And so for that reason, it's sort of akin to base layer money, like gold, right? It sits there, it doesn't do anything. With something like money parked in a Lightning channel, you're earning a base fee, you're earning a fee rate for actively managing the channel, right? Managing inbound and outbound liquidity, adding new connections, etc. So that's sort of like your risk-free rate, right? We call the suite of treasuries, U.S. treasuries, the risk-free rate, namely the 3-month bill and the 10-year note, because the default risk associated with them is the lowest in the market for rates. That's sort of the moniker risk-free rate is where it comes from. So the Bitcoin equivalent would be the Lightning Network, right? And Nick actually wrote about this originally in his piece called the Lightning Network Reference Rate. And I spun it off into the time value of Lightning Network. And essentially, these rates you can earn on the Lightning Network, more of them are starting to appear. So we mentioned liquidity marketplaces. Because there's more associated risk there with leasing out your liquidity, then that trades at a premium to Bitcoin just sitting on the Lightning Network. And then also we talked about Taro. So because you're incurring more counterparty risk than you are with just leasing Bitcoin, because whatever asset the person is issuing, you incur all the counterparty risk associated with that issuer, that demands a higher premium than just leasing out your liquidity. Like if you wanted to lend a Taro asset, for example, you'd demand, you'd have to pay out a higher premium, right? And then obviously, like sort of at the top end of the curve would be lending off chain, because you don't have the security or the assuredness of lending on Bitcoin or Lightning. And so there's sort of this parallel market for interest rates that's being built native to Bitcoin and Lightning. It's offering an alternative to the highly manipulated, distorted cost of capital that we've been given with the Federal Reserve and all the associated interest rates.